Welcome to another episode of Good Value by Antipodes.
Welcome to our first podcast episode of 2025, a year which begins with a new US president, buoyant stock markets, extreme market concentration, and a number of value opportunities across the world. Today, I'm joined by Antipodes CIO Jacob Mitchell, and we're going to discuss the state of the markets, where we see the best opportunities for investors, and how we're positioning our portfolios for the year ahead. Welcome back, Jacob.
Thanks, Alison. It's great to be here as always.
Jacob, first things first, we're recording this not long after Donald Trump's inauguration. Post the election, you've been in the press and talking to investors about the investment implications of Trump. So has anything changed over the past few weeks?
Look, even now that Trump is officially president, there's still a lot of uncertainty around policy. That's probably an understatement. Until we have some, firm policy announcements, I think it's really is a fool's errand to overthink the implications of Trump. We can see that in the market, certainly US equities, they've been very quick to price in the investor-friendly components of Trump's signature policies, such as tax cuts, deregulation, but really have ignored, some of the less friendly pieces due to guessing games around tariffs, immigration and deficits. Now, look, we've seen this before in the first term, a lot of uncertainty, but I would argue the environment is less forgiving. You've got the elephant in the room, which is the government debt to GDP at 120%. That's much higher than in 2017. The fiscal deficit is already at 6% of GDP. Policy rates are higher, and the cost of funding the government debt is higher and likely rising. How to contextualize that? The US government spends more on its interest bill than it does on national defense. The duration of that debt is still relatively short. It's about 6 years. If all of that was to refinance, it would cost roughly 4.5%. And that interest bill would rise to almost, a quarter of government revenue. On top of all of that is, the multiple being applied to US equities is also higher at 22 times forward versus around 17 times in early 2017. So it does feel like the market is priced in, a lot of the good news. And so, trying to predict the unpredictable, we're bringing it back to what we can control, which is ultimately, looking for businesses that are resilient in the face of uncertainty, have reasonable valuations, and if they're cyclical, they're at the right point in that cycle, and also looking for structural elements, in terms of outlook. That approach, I think, protects capital against uncertainty.
So you called out, and we all know that US equities had been strong. But the bond market has been telling a different story, hasn't it? You've seen yields rise, even as the Fed has cut rates. And that's pretty unusual. Now, is that because of a combination of Trump uncertainty, inflation remaining above target, and also, we've had strong economic data?
Yeah, look, I think the rise in yields is a combination of the bond market needing more term premium, to fund that deficit. As the US government tries to term out the debt, it was funded, a lot of funding recently, for the last few years from COVID was at the short end. And you can only go so far before you have to start terming out that debt. Investors want, they want to be compensated for, holding a longer duration bond more than a shorter duration bond. So you had to put some, let's call it positive, from a negative yield curve, you had to start putting in more of a positive yield curve to get the deficit funded. Secondly, as you point out, the economy, inflation being a bit more sticky, investors need to be compensated for that. So it's been a combination of, out there on the 10-year, more real, the real yield going up as well as effectively the nominal yield going up. And look, we've seen also, with Trump, you've seen probably just a combination of that deregulation, tax cut rhetoric, business getting very, very bullish on the outlook. And so you've lost some of those rate cuts. Investors are thinking that the growth outlook is improving. Time will tell. But, we went from sort of an expectation of about 100 basis points in cuts by the end of 2024 to less than 40 basis points, only 1 or 2 cuts. So, a shallower cutting cycle, arguably a higher neutral rate. The neutral rate of interest refers to that real interest rate where monetary policy is neither stimulating or constraining growth. And that's cascaded through, the yield curve. Whether those higher yields, which are effectively a higher discount rate, is being priced into the equity market, look, that does become a headwind at some point. And then there's the deficit. What's the direction of the deficit from this point? We have a lot of the market's thinking a lot about the benefits and of various tax cuts, but that ultimately needs to be funded, and that cost is being estimated at about another 17% on total debt to GDP as a result of Trump's policies, if we don't find any savings. And if we don't find those savings, and look, investors want to believe that DOGE and other policies will seek out savings, you have to also think that comes at a cost, right? And there will be parts of the economy that do suffer if we reduce the fiscal deficit. So there is a double-edged sword there. Fiscal sustainability is all about growth. You can have fiscal deficits as long as you're growing, and that's if you don't see growth, in the US, if there are question marks around growth, then you really do sort of start to see that risk of the Liz Truss moment that the UK experienced, where there is definitely an issue with growth. That's definitely on the cards. We don't know about the tariff and immigration policies that still yet to play out, and the impact on growth and inflation of those policies. You put it all together, there's a fair amount of uncertainty, and that can drive a higher risk premium in both bonds and equities. So we need to watch as policies start to roll out in the next while, and think about the real impact on inflation and growth of those policies.
Let's pivot to our global portfolios. So we've been underweight US equities for a while. How are you thinking about this as you look to the year ahead?
As a pragmatic value manager, no surprise, we do focus on valuations. And look, overpaying for a quality opportunity, or at the other end of the spectrum, buying something that's low quality or a weak business just because it's on a low multiple, does risk capital destruction in both scenarios. There is reasons to be optimistic around economic data in the US, but there's also uncertainty. US equities in aggregate do look expensive relative to their own history, the rest of the world, even when you strip out, the mega caps. At the index level, we would say there's not a huge margin of safety or margin of error. That said, we're still finding great opportunities in the US, and across the portfolios, it's certainly our biggest single country exposure, and we see more broadly in the portfolio opportunities to access exposure to the US in regions where those exposures are priced more cheaply. So we're not ignoring the opportunity. For example, a recent addition to the portfolio is a pure play US natural gas producer, EQT. It's been it's a company that's been building its position in the Marcellus. There's been a degree of consolidation. We're seeing great supply dynamics because as the oil prices moderated at the same time that a lot of the oil companies have sort of got religion around capital management, oil supply and associated gas supply in the US is full. It's not growing at the same rate it was. So we think in natural gas, you've got the pure plays are benefiting from more supply discipline at the same time that the demand profile, is looking well supported by, just the need to replace coal. And also, you've got this new element to demand, which is repowering the US, to support, AI investment. So that's an interesting opportunity, pure play US stock. In financials, as our investors would know, we've been very constructive around companies like the credit card digital bank operator Capital One Financial. We scaled up that exposure last quarter. Also, Ali Financial, whose primary business is auto loans. Both are relatively well capitalized, where earnings should be resilient regardless of the policy rate environment. They'll certainly benefit from lighter touch banking regulation under Trump, which frees up capital for high shareholder distributions or loan growth, or a combination of both. In terms of the mega caps, our holdings there are really anchored by Alphabet, which we scaled up last quarter, and Microsoft. Microsoft is a cloud AI winner, but its share price lagged in 2024 on slower growth in that Azure cloud infrastructure business. We think Azure growth should re-accelerate, but like second half of this year, as chip supply constraints start to ease. And still, we still feel, certainly just with broad-based cloud adoption, you're still, less than a third of the way through the runway of growth there. And then AI AI adoption is really icing on the cake. Alphabet, it's the only tech stock today that we think has the integrated AI stack from, a proprietary large language model supported by proprietary hardware with their TPU chips, and application layer, and very importantly, distribution to both businesses and to households. Yet it's only performed in line with the S&P. It's at 19 times earnings. It's on a lower multiple than the S&P, despite we think a stronger than market growth profile.
One of the key drivers of US exceptionalism has been the US government outspending the rest of the world. And I know we were looking at some data internally at Antipodes, which showed that from 2020 to 2023, the cumulative fiscal deficit in the US was almost 40% of GDP. And you compare that to Europe, and Europe's around 20%. And you're starting to see some market commentators questioning whether the fiscal gravy train in the US, is that over? And then on the other hand, we have political change in Europe, and that could see policy loosen. So do you think we could see a change in fiscal impulse?
Yeah, that's a great question. I think, there's two ways to think about it. It's the bigger picture, which is a lot more stimulus in the US fiscally, as you say, than anywhere else in the world. And when investors say, talk about US exceptionalism, I think there's two elements. There's the structural element, but there's also a cyclical element here, to the extent that US corporates have outgrown the corporates in other parts of the world. There has been some supercharged fiscal stimulus behind that. So you could argue there is a cyclical element that's enhanced the structural element. And you shouldn't, I think, as an investor, extrapolate that cyclical element indefinitely. In Europe and other parts of the world, you've had a lot less of that cyclical support. And I think investors are extrapolating the other way and saying there's no structural growth here, or the structural element's much worse than it actually is. So we'd be on the other side of that argument and saying that Europe does, and China, they do have up cycles, and you can make money in those up cycles. And I think, with all eyes on Trump, maybe the markets are missing, what's happening in Germany as, one of the core economies in Europe. The centre-right CDU party led by, Friedrich Merz, is likely to win, and there is a real shift. Merz is a former chairman of the supervisory board of BlackRock in Europe, and we think that real focus on austerity and deleveraging since the 2008 financial crisis. There's been tightness in policy, tightness in the availability of credit. And we think if Germany moves to a more business-friendly, more stimulatory policy setting, then you can see, I think, a cyclical recovery. The banking sector is pretty healthy. Real wages are rising as inflation is falling. The ECB is cutting rates, probably has more fiscal flexibility, has more policy flexibility than the Fed. And a shift in the political landscape, to as we've described it, can put fiscal stimulus back on the agenda. Germany needs to invest. It's arguably underinvested in its own public infrastructure for the last 30 years. It was pretty good 30 years ago. And then we now think it's even at a point where that investment has fallen below depreciation. So it's an economy. It's difficult to grow without adequate investment, and that can be the real change in attitude. As if Germany shifts to the idea that it needs to catch up on investment, which I think it will. On top of that, there's natural need to invest as Europe, similar to the US, is looking to reshore certain parts of its global supply chain. You've got the need to sort of Russia's energy supply. Clearly, Europe's needs to think about reshoring, not just in relation to China, but also in relation to the US, and how it's going to respond to any sort of generalized tariffs. And look, that's happening at the same time that the US is arguably, the amount of fiscal stimulus from the US is starting to, certainly if it doesn't fall, it could lead to sort of a more pressure on rates. I think there is a case that Europe can improve from a cyclical perspective.
And then do you think this can be the catalyst that then narrows, for a long period of time you had this very, very wide valuation between European and US equities. So what you've just discussed, can this be the catalyst that narrows Europe's valuation discount?
It's at almost a 30-year wide. So any sort of cyclical improvement, I think, can see that discount narrow. But that really isn't why we're overweight Europe. It's not based on that macro view. It really is just the fact that we can find great, resilient companies, many of them multinationals, that could just as easily be listed in the US, and probably wish they were. And they're cheap. They're cheap relative to the their growth profile and peers listed elsewhere in the world. Companies like Siemens, Airbus, but also on the domestic front, like a well-capitalized bank like Soc Gen in France, we think is on a 4 times, if 2-year forward PE, and buybacks and dividends represent a 20% yield. And then something like Sanofi, which is, as you know, I like a multinational pharma stock with its biggest market being the US, very limited drug pricing risk as we assess it, no material patent cliff risk, and a near-term catalyst as it starts to sort of refocus its business with a divestment of the consumer health business.
And you mentioned China earlier, and policy is loosening, but the market has been frustrated by piecemeal action. And we know that relations with the US remain fraught. But the US-China dynamic, it is nuanced, isn't it? Because on this one hand, you have pretty aggressive rhetoric around tariffs and trade. But then on the other hand, we know Trump is notoriously market-focused, and we can see a real-time example of this playing out with what's going on with TikTok. So tell us, what's your view on China?
Yeah, I think what you're saying is Trump is is the ultimate, likes to perceive or position himself as a deal, the ultimate deal maker, and transactional, and that can benefit China and the US in a way in the short term. Probably one of them may be looser in the longer term, but certainly in the short term. I'm not really going to try and predict what that would look like, but we also have to just keep in mind that, the total exports to the US, I think the number, what do they represent? I think it's about 2.5% of GDP. Let's just keep it in context. And what I think has happened, though, from the China perspective, is that they will, they really have started to shift, I think, in their mindset anyway, about, rather than the big priority being modernization of the, the manufacturing economy with a real focus on semiconductors, to now being consumption, and protection of policy of the property, sector, really supportive policy for property and supportive policy to consumption. So that, I think is what that backstops. I think that backstops the economy. I think it protects the economy from stagnation or deflation. Let's call it a real deflationary stagnation. And look, the market is, I think, if you think about just the potential for some looser fiscal policy, stable housing market, stabilization, I should say, in the housing market, and a modest pickup in consumption from, a level of savings that's way above trend. There's not, relative to on how the market is being priced, where it's sort of like there's no real hope. I do think you can, have the market on about 12 times forward earnings, and when we look at the companies that we have or own in the global portfolios, we think their earnings are probably going to compound at around 20% per annum over the next 3 years. They're going to grow much faster than the economy, and we're investing in companies, not economies.
Yeah, or the index.
Yeah. So we remain constructive. We think the downside scenario is well and truly priced, and there are some upside scenarios where you could actually see something much better than our base case.
Yeah, sure. Okay, great scene setting, really setting us up for the next 12 months. So, Jacob, for our final 5 minutes, I want to definitely put the spotlight back onto stocks. So, at the end of last year, I had the Antipodes sector portfolio managers each give me a stock to own and something to avoid in their area of coverage. And I got 5 great stock tips. So we had Keysight, Alcon, RWE, Google, and Didi. So great cross selection there. Now it is your turn in the hot seat. What to own and what to avoid. And if you're brave enough, we're going to revisit these next year. So that's the warning.
Absolutely. Look, I'm going to start in terms of what to own. Give a couple of ideas. I mean, one of them is more of a thematic, highlighted, I think, with the recent sort of focus on DeepSeek and what DeepSeek means for AI. AI, arguably in the last 18 months, has been played aggressively in the enablers. So it's been, NVIDIA as the real lead in that pack. And as we need to ramp up investment to support large language model development training and the beginning of the deployment of those models through inference. And then DeepSeek has highlighted that, the cost of inference is falling at an exponential rate. And that ultimately leads to the conclusion that, you bring forward the adoption of the benefits of AI and broaden out the use cases. And I think you're at that cusp where the market may sort of focus less on the enablers, and there's arguably a potential, for overhyping some of those enablers in the way that they're valued to some of the corporate beneficiaries of the deployment of those the deployment within their business of productivity tools. Either they get the internal benefit, or in the case of the software companies, they're selling that benefit to an external party. And I think, our investment in outside of software, but in companies like Capital One, it's a great example of, a digital bank that's built natively in AWS. So that means it can efficiently deploy AI tools in its existing IT stack. Now, most banks in the world can only dream of that, right? And so I think it should be able to capture the benefits of that in its business, whereas a lot of companies won't. The benefit will probably get competed away. I think that's a great example of how we think that could play out in a broad sense. Secondly, something that has nothing to do with AI.
Is there anything that doesn't have anything to do with AI?
Well, I'm sure there's an angle, but we have owned, we own in our top 10 Barrick Gold, and there's been some near-term negative news around their exposure to Mali, which means the stock's pulled back. I think there is a great, arguably a good idiosyncratic case for the gold stocks. The focus is very much on capital management. I think there's much more focus on return on investment in these businesses, on managing cost better, and they're not getting rewarded for that in the stock market, and I think that can change. Secondly, there is a macro element which is also not being reflected in the stocks, which is the gold price has been strong. And the question would be, with real rates being moving up over the past 3-4 years, why has the gold? Typically that's a real headwind for gold. And the reason that's happening is because of the geopolitical tensions that we all know about. The PBOC, the Chinese central bank, gold holdings make up only 5% of reserves, roughly, as far as we know. So there is scope for China to continue to scale that up. As they look at what's happened to Russia and how its reserves were frozen, there's not as much appetite to hold those surpluses in US treasuries. So to put some numbers, long-term central bank net purchases of gold have sat around about 160 tons per quarter. And, last year that rose, to an average of 230 tons. And some estimates suggest that, in November last year alone, central banks bought about 117 tons. So we think that is just a structural shift in demand. And we think even in a soft landing, no landing, it kind of underwrites the gold price. Now, what's missing in the rally in gold is retail participation. I think you've got a free option on if the US economy is weaker or inflation is higher. So if you get that stagflation scenario, that's when gold becomes very interesting, and it's not really priced into the stocks. So we've got about 4.5% exposure, with Barrick being the key holding, and we think there's a great opportunity there at 8 times PE at the current gold price. It's pretty cheap relative to its history and also to peers.
Okay, so we've got long those companies that can start to take on AI and use that to improve efficiency or sales within their own business, and long gold. So I really like how you've turned one stock pick into 2. Well done. I remember a portfolio manager doing that last year. Okay, now what are you avoiding?
Some people might find it controversial, but it's Apple. I mean, it's weird. Like, Apple is the most boring of the Mag 7. So in a way, it's and look, it's done better than we would have expected. So it's typically a stock that many institutional investors are underweight, and then it hurts their performance. And it's well owned by retail. It's just a question, I think, of where longer term, can it re-energize the business? It's very dependent on the smartphone hardware profits, It's, the iPhone 16, it doesn't really have a lot of new innovations. And as a result of that, they are losing share in China. And we think, the new round of innovations clearly will be AI related. But it seems to us that the Android ecosystem is moving faster. And, the Android system is more open. I think as a result of it being more open, it does innovate faster. And this is a big shift in technology. I know Apple's always been a leader. A fast follower rather than a leader, but it hasn't traded also on this multiple. So the multiple, I think, is implying that they follow very fast. And if there's any disappointment around that, it will impact the share price. Look, in China, there's definitely a real growing preference to buy local brands. Huawei, Xiaomi, Vivo, they have these flagship models that really compete, that are very, very, great designs, great performance and cheaper. Whilst outside of China, the iPhone's doing better, but the numbers still suggest relatively flat volumes. So that's not enough to offset weakness in China. We think that probably, even with AI features, they've probably pushed the price point on our iPhone to the point where they probably can't push it much more. So its last 3 years, they've compounded earnings at around 6%. Consensus has this accelerating to 10%. And we do think there's risk. And at 30 times, that's at the top end of its 10-year P valuation range. It's expensive relative to history, and it's expensive relative to the broader S&P. So we definitely see better value elsewhere, like Alphabet, Microsoft. Microsoft's at 26 times, and we see that growth mid-teens level, and we see it as relatively well underwritten.
Fantastic. Thank you, Jacob. It's always great to have you on the podcast to hear what you're thinking about when it comes to global equities. And, you've given us 2 stocks to own and one to avoid. So thank you for your time.
Excellent. Thanks, Alison.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.